Gentlemen, welcome back. You're back with MGTOW Money. Today's topic is going to be how you can join the top 10% of stock market investors. Before we get to that, in case you're new to this channel, this of course is MGTOW Money, which is the only MGTOW channel dedicated to your money. How you can make money, invest it more wisely, and maybe, just maybe, retire early. Now, again, today's topic is going to be on joining that top 10% of stock market investors. This is part 3 in a series. I did part 1 on individual stocks. I did another video on bonds, on how you can buy individual bonds and what that's all about and that type of thing. And today we're going to be talking about mutual funds and index funds, and I'll touch briefly on ETFs, exchange traded funds, which are a close cousin to mutual funds and index funds. Again, just like in the 2 previous videos, this is not, of course, a comprehensive discussion. This is not an in-depth discussion about this particular subject. This is the 20% that you need to know that'll cover 80% of your needs. Let's define a fund. What we're talking about when I say a fund, whether it be an index fund, whether it be a mutual fund, we're simply talking about you investing your money as part of a pool. In other words, potentially thousands, hundreds of thousands, millions of people, just like you, putting your money together, giving it to an investment firm, a la Vanguard, Fidelity, T. Rowe Price. These are just a few that come off the top of my head. Merrill Lynch, etc. You're pooling your money together with other people. You're giving it over to this investment firm, and you're saying, okay, Mr. Investment Firm, I'm going to put my money into this idea that you have here, this strategy, and they're going to take that pool of money and they're going to tie it all together into a big bundle, into hundreds of millions, if not billions of dollars, and put it into a particular strategy. The advantage to investing in a fund, if you will, is that it's almost sort of a no-brainer. Many times a fund can provide to you, a mutual fund, an index fund, can provide to you nice, broad diversification. This is very, very important, where in other words, as opposed to you putting all your money into one individual stock or 2 individual stocks, which of course, as we talked about before, can, not just theoretically, but it is possible, can go to zero and you literally lose all your money or lose a big chunk of it. Instead, a fund can diversify you across many stocks. For example, there's something called the Total Stock Market Fund. That fund holds over 5,000 different companies, different stocks. So when you put your money into the Total Stock Market Fund, you're having your money spread among 5,000 different stocks. The likelihood of you losing all your money in that is infinitesimal. It's basically zero, of course. There's, of course, other ways of diversifying your money, but this is a very simple, easy, again, sort of a no-brainer way for you as a beginner or even many experienced investors to put money into the stock market without doing a lot of research, without doing a lot of homework and thinking and looking at P/E ratios or studying charts or what's the price to book ratio on this stock, etc. Instead, you're just turning it over and it's being spread among many, many stocks. Now, it's important though to differentiate that funds can be actively managed or they can be passively managed. When we talk about actively managed funds, we're literally talking about a fund that might have a man, a woman, God help us, or multiple people managing that fund. In other words, literally on a day-to-day basis, they are looking at the pool of money that they have and deciding on, okay, do we want to add additional money to, let's say, Ford Motor Company, and we want to reduce the amount of money we have invested in Facebook? Or maybe we need to buy some gold stocks because they might be getting hot now and we want to reduce our exposure in the bond market or something like that. So in other words, again, with actively managed funds, the money is being shifted on literally on a regular basis, and it could be on a daily basis or even an hourly basis, depending upon the market conditions, upon what the manager feels like is happening. The other way of investing your money in a fund, and a specifically fund type, is an index fund. An index fund is a passively managed fund. Typically, index funds are dealing with a group of stocks, or it could also be a group of bonds, that is set. So I'm just going to use a hypothetical, but this is fairly realistic. January 1st of the year, Standard & Poor's, which is a company, Standard & Poor's creates the S&P 500. The S&P 500 is literally a list of 500 stocks, 500 companies that they've decided upon. This is going to be the 500 stocks that we think will do well this year, and we are going to allocate certain percentages to them, and we're going to publish this list of 500 stocks. You, the individual investor, can go purchase a tracking mechanism, if you will, an index fund, if you will, that will follow how those 500 stocks do for that calendar year. So, for example, again, January 1st, you buy the S&P 500 through a index fund. That's what it is. The S&P 500 is an index. You're buying this index mutual fund, this passive group of stocks that's going to remain the same for that 12-month period. It won't be changing unless there's a buyout or something, but basically it's going to be set for that period of time. And it will rise and fall depending upon how it happens to do. Another example I'm sure many of you have heard of is called the Dow Jones Industrial Average. That's simply a group of 30 stocks as opposed to 5 stocks, instead of 500. Again, the idea being you're buying a group of stocks that's effectively set for a certain period of time. And again, you're just sort of going to sleep. You're turning over your money and you're forgetting about it. Not just in the U.S., but you can do the exact same thing in other countries, whether it be the FTSE 100. I know there's a tracker for the Australian index. There's a tracker for the Canadian index. There's a tracker for the French index, the CAC index. Point being, this is an even simpler way of not even having to think about, okay, I just want to put some money into the stock market. I'm not going to be touching this money 5, 10, potentially 20 years into the future, and I'm just going to kind of go to sleep with it and turn it over to this passively indexed group of stocks. Very simple, very easy to understand, provides excellent level of diversification. A couple of key points that you always must ask, and the most important one is the following before investing your money into whether it be an actively managed mutual fund or an index fund, is the following. What is the load? What is the front end load? In other words, is there some sort of charge, some sort of door fee that I've got to put up money to get into? If they say yes, walk away. No, let me change that. Run away. You do not want to pay what's called a front-end load. You want to invest your money in no-load funds. So very important term. You want to say, is this a no-load fund? It probably is. A lot of these front-end load funds have disappeared, fortunately. However, some of them are still around. So again, number one, you want to ask, is this a no-load fund? Number two, just as importantly, you want to ask, what is the annual expense ratio? What is the annual expense ratio for this index fund? What is the annual expense ratio for this mutual fund? Ask it just those terms. This is very, very important. You will pay whatever they tell you the expense ratio is. You pay that money, although you won't pay it out of your pocket. It comes out of the money that you've invested, but you will ultimately pay that money. So, for example, if someone says the expense ratio is 0.25 or 25 basis points, what they're saying is that it's $25 per year for every $1,000. As a rule of thumb, do not, I emphasize, do not put your money into any mutual fund that has an expense ratio, an annual expense ratio above 0.75. 0.75. So 0.75 should be the absolute upper limit of anything that you want to invest in. To give you an idea of some mutual funds today, and I emphasize that some like the S&P 500 index fund, some of those funds that you can get, I think, through like Charles Schwab, for example, have an expense ratio of 0.10, $10 per $1,000. They're almost making it free for you. So you can see you can have a wide variation from $10 per thousand to $75 per thousand. Number two, a second important point that you've got to remember when you're deciding on a mutual fund or an index fund is do not get hung up on the past performance. When they start showing you charts or if they start quoting statistics, well, this fund was up 27% last year, do not immediately assume, oh, well, if it was up 27% last year, it's going to be up 27% this year. No, you don't know that. Go back to what I said before. Go back to how many times I've said this before. You cannot predict the future. No one can predict the future. That fund could easily go down 27%. The most important thing, if you want to look at past performance, if you really want to dig into this, ask them, what is the worst year this fund has had? What is the absolute disaster? What is the largest drawdown? That's a term that you might hear. What is the largest drawdown that this fund has ever experienced? 20%, 30%, 50%? The point being is that'll give you an idea of, at least in the past, what has been the worst case scenario, and you can decide, can I deal with that? At least intellectually, can I deal with that? For example, the S&P index about 10 years ago or so was down over 50%, 50. I can assure you a lot of people panicked and a lot of people correspondingly lost a lot of money. Don't say that won't happen to you. There were lots of smart people, very smart people who were saying the same thing. Oh, I'll never sell. I'll hold on. And ultimately they did sell. Number three, this is how you are going to join the top 10% of investors. And it's so easy to think that, well, I'm going to put my money with an actively managed fund because I know that I'm going to get some tremendous all-star guy who's got this fantastic track record, who's done well year after year. Because effectively, when you are putting your money into sort of an index fund, you're going to be mediocre. You're going to be average. You are never going to be able to go to your friends and say, I just tripled my money this year, or I was just even up 45 or 50%. That's extremely unlikely. More likely what's going to happen is you will, by putting your money in a passively managed index fund, and I shouldn't use the word managed, but by putting it into an index fund, it is going to be simply getting you the average. The average, at least in the United States and pretty much the world over, since 1920 or so, is probably around 9, maybe 10%, give or take. So figure on average, you're going to get a return on your money in total of 9 to 10%. That is an average. That is not a guarantee. And of course, the stock market can go through multiple years, even decades, where it does really nothing. So just be aware of that. How you're going to join that top 10% is the following. You're going to take your stock allocation, and specifically you're going to take, I recommend, 80% of your stock allocation, 80%, 80, and put it into a passively managed index fund. So 80%, using an example, let's say that I have $10,000 that I want to invest in the stock market. I'm going to take $8,000 and put that into a simple index fund, a passively indexed, managed index fund that just sort of sits there. The other $2,000, of course, I could put into individual stocks. I might want to do some sort of speculation, if you will, into gold stocks, or maybe I want to buy real estate stocks, or maybe I think, you know what? I think the Russian stock market is going to be hot this year, and I'm going to put some money into that, or the Brazilian stock market, or I'm going to put it into some sort of emerging market like the Vietnamese stock market. Yes, you actually can buy things that are based around the Vietnamese stock market index. The point being is that, again, the bulk of your money, the great 80% that you're using that's of your stock portfolio, is going to passively indexed funds, with the other 20% you're using for more speculative purposes. Gentlemen, as always, I hope you found that helpful. We, of course, are building an army, an international army of MGTOW financially independent men. And because I need your help and we're moving this forward, I need you to hit the like button if you found this helpful. I need you to hit the subscribe button if you haven't already. And I need you to share this video on forums with friends, etc. As always, John Galt out.